sort of during my time on Wall Street, I found that people just didn't have data to make good decisions. And the hope was that in founding this center, we would be able to provide good data that underlie decisions. So I think our biggest focus has actually been credit availability. The credit box got very, very tight in the aftermath of the great financial crisis. That is, it was very hard for borrowers who didn't have pristine credit to get a mortgage. And, so the credit box tightened to the fact that to the point where we were prepared to tolerate a fairly low probability of default. It's been sort of slowly expanding until COVID-19, at which point it's tightened considerably. I think Dodd-Frank itself has been a huge help. I think the qualified mortgage rule, which basically says, hey, you can't make these non-traditional products that haven't be a qualified mortgage, was a tremendous help. One additional restriction, which was not part of Dodd-Frank, but in implementing Dodd-Frank, the Consumer Financial Protection Bureau decided that there should be a hard 43 debt-to-income limit on mortgages. The CFPB is looks like it's finally going to get rid of that 43 debt-to-income rule. So here's what's working well about the mortgage market. So first of all, homeowners were less impacted than the population as a whole. The GSEs at FHA and then Congress moved very, very quickly with forbearance, which basically allowed borrowers who are in trouble to essentially defer payments on their mortgage, which has been very powerful. Because the Fed has eased so dramatically and interest rates are at their lowest level ever, you've had a huge increase in the number of people looking to buy their home. And of course, home prices haven't risen as quickly as interest rates have fallen, so more people can afford to buy. That said, here's what's not working. The credit box has tightened dramatically. It's much harder to get a mortgage than it was before. And it's also hard to refinance your mortgage. So I think the tightening of the credit box has been very dramatic. There have been a lot of advances in the credit scoring models, none of which are incorporated into the mortgage process. So if you have a borrower who either doesn't have a credit score or who has a low credit score because he's a fairly new user of credit, but he has 2 years of on-time mortgage payments, that should be a great predictor, and we're not using it.